Good stuff. Right, it is 11 o'clock. We should get going because we've got a fair bit to get through this morning. So obviously I'm going to be dealing with news, and then Andrew's going to be talking to us about what happened during August. And then I'm going to be talking to the merger of Ashoka India Equity. So bits of news first. Three things I pulled out. Fidelity, Caledonia, and SDCL. And we'll start with Fidelity Emerging Markets. This looks like a pretty good chart, actually, and you can see how well EM has been doing, especially post-Liberation Day. So that drop in April was the Trump announcing the tariffs, and then since then, markets have rebounded nicely. Maybe because the tariffs haven't been as bad as feared, but there's also quite a lot going on. It does feel as though, to me, investors are finally taking a little bit of money off the table in America and putting it somewhere else. And we're talking about such vast sums of money that really does move markets. So the emerging markets have started to move, and I think we could see a lot more of this. It's definitely a thing that tends to be associated with a weaker dollar anyway. So this is a decent sized fund, 550 million. Discount's a bit too wide, about 9%. One of the things that it's got a quite concentrated share register. So there are two really big shareholders, and one of those, Stratified Pension Fund, has decided it wants to sell out. So the trust wants to repurchase its entire stake, 25.7% of its shares, and they've agreed to do it at a 14% discount, which is really quite generous from the pension fund's part. It's still, because it's a big stake in the company that's being sold and it's being done in a one-off transaction, just a one-to-one transaction, it's a related party deal, so it needs shareholders to approve it. I can't believe anybody's can vote against this, though. It's going to happen, assuming everything gets approved in November. By buying it back at a 14% discount, so 5% wider than the current discount, that boosts the NAV by 4%. That's obviously great news, especially because you expect that the discount will move with it, so that we will hopefully get stay on the line to at least get the 4% represented in the share price. It does create, though, one sort of mega shareholder in that City of London is already up there between 9.2%, and they will go to 39.3%. So they are discount-driven investors. They're not. I mean, they do some activisty type things, but they're not about to bust this trust up. If they like a fund and they've used a reasonable job and it's doing something about knowing the discount, and they're generally happy. So I don't think they'd be desperate to sell out. If they bought one share because of this whole thing, they'd have to bid for the company, but I don't think they will do that either. So really, it's down to Fidelity Emerging to convince investors that they want to buy shares off City of London, and if they can do that at certain narrow discounts, then City of London stake will just come down naturally, and I think that's where we want to travel to. So there you are. You can see it in the peer group there. So it's about the third biggest trust at the moment. Obviously, doing this buyback will push it down a bit in terms of the league rankings, but it's got quite competitive ongoing charges that won't really change much, and its discount is just over halfway down that list, and it should be a bit narrower. And the star there is Ashoka White Oak, which is the sister founder, the one we're talking to in a minute. And then on returns, Fidelity's had a very good year last year. But you can see, now I showed you that chart at the beginning, it all looked wonderful. If we went back a little bit further, not quite so wonderful. And the reason for that is because when they took on the mandate for Genesis, they put some money into Russia, and then the war started quite soon afterwards. And that caused a problem with, obviously, because you had all the stuff that was valued and then valued at zero. And that's still sitting there in the background. JP Morgan Emerging EMEA, that used to be JP Morgan Russian, gets credit for the fact that it's got all this Russian stock that it can't sell, but the other funds with exposures like that, like Barings and Fidelity, they don't seem to, and I don't really understand why, but there we go. Caledonia, here's a chart. it's really quite peculiar the way that the NAV just keeps on climbing, and the share price just stalled back in 2021 and hasn't really gone up, and the discount just gets wider and wider. And I don't think there's any good reason for it. And what they've done this week just underscores that. So they have agreed to sell their stake in Stonehenge Fleming, which is a family office group. They're going to get £288 million for it, plus maybe some more. We'll talk about it in a second. That's coming in different tranches, so they're going to get 250 million up front, and then some payments 6 months and 6 months after that, and then maybe another 9 million if it hits some revenue growth targets. And it should all be done in the first half of next year, because it needs to use some approvals. This has been a really good investment for Covered Warrants. So it's obviously a private company; it's not a listed thing. They first invested in July 2019, and they're going to make 3.2 times their money in 6 years, which is obviously pretty good going. And also, another thing that sort of we keep saying about private equity trusts, and if you were listening to the show last week, it was something we talked about then. It's a big uplift to the carrying value in the NAV, and this does tend to happen quite a lot with private equity. So 30% higher than it was valued at the end of March NAV. So that adds 2.2% to Caledonia's NAV, and just reinforces the case that the discount, I think, is too wide. The private capital bit there is 29%. This is at the end of July. This will obviously come down a bit. They'll report cash. I'd expect them, given their strategic allocation of 25 to 35%, expect them to reinvest it. But the whole thing with Caledonia is they take their time, they think about stuff, they do things carefully. They won't be rushing to do this deal. They'll sit in cash for a while if they feel like it's appropriate to do so. And I think we've got a note coming out relatively soon, so you should be able to read about the rest of the trust very shortly. STCL, last one from me. Classic renewable energy chart there, where again the discount just gets wider and wider and wider, although the NAV sums have come down a bit, although it's done a bit better than some of the other peer group in terms of that. Discount 36% is way too wide, but he's still paying a dividend, and that puts the yield up to close to 11%. Now, the story here is that Saba's got involved, so they've now got a 5% exposure to it. They don't really hold those shares; they only hold 441,000 shares in their own name. Everything else is done through a total return swap, so they haven't actually sort of put them on the register. So they haven't tried to get involved with calling meetings or anything like that. This is not what they're about. Now, the interesting thing is, Saba doesn't normally do this. It invests in the discount, and it does that by buying the shares and then subletting the underlying investments. So the only exposure is to the move in the discount. So you can get much more bang for your buck doing that. But there's no way that they can hedge the underlying. I mean, if this was a really straightforward renewable energy fund, like sort of Next Energy or Bluefield or something like that, and the underlying solar farms, you'd still not be able to do that properly. But this is a really diversified fund with lots of different sorts of assets in it. So there's no way they're going to be able to do this. So I think they probably haven't tried to hedge it, or if they've done it, then it would have been something really crude. So it feels to me much more like a straight bet on the SDTL share price going up rather than the discount narrowing. And also, the other thing they normally avoid is buying things on really high yields, because that it really penalises them in terms of US taxation. So they seem to be prepared to take the pain on this in the hope that they get the share price uplift. And this is what makes it also unusual. And I don't know whether it's a sign that Saba's running out of things to do in the equity market, which is something that I've suspected might start to happen, but not quite yet. But we'll just have to see. The fact that it's announced after the AGM, and they've only got 5%, they'd have to go to 10 if they wanted to call an EGM. So they have to buy more, which would drive the discount down. Otherwise, if they're just sitting around waiting for next year's AGM, it's quite a long wait. So we'll see what happens. And STTL have already done some things. So they're conscious that the discount's been too wide. They're conscious they've got to do something about it. They've already cut the fees. They've told us what the dividend's going to be this year. They've told us it's going to be covered, which is all tick, tick, tick. And the first of those dividends is about to go X. And they've said that we know that you can't just carry on as we are with a massive discount. So we're looking at strategic options. So this was all done in June. And then on the 10th of July, they refinanced our portfolio, which I think it's somebody paid down the revolving credit facility. And then on the 30th of July, they said they'd sold something, again at a premium to NAV, and using that money to pay down debt. And they're going to carry on doing that. That seems to be the sort of preferred option. So sell things off, use the money to pay down debt, and then make returns to shareholders and force buybacks, presumably. So that's it from me. I'm now going to hand over to Bentley.
That's great. Thank you very much indeed, James. Thank you. Yes, I'm going to talk about what happened during August and exactly what moved in the investment trust sector. And I think the answer was probably a little bit less than is common. So August actually did have the feeling of a traditional quiet holiday month, which I sense we haven't had for a number of years, actually, but it was more of a traditional August when many market participants went away on holiday and there was less news. I think that was crucial. And I think that allowed some thematics to play out. So this is the list of risers over the month. And I think the numbers here are fairly typical. So one or two big ones and then several around 10%. But there are, I think, some very definite themes in this list. So if we have a look at those, I think there are three really. First of all, certainly commodities and in particular precious metals is an important theme, and I will talk about gold. Secondly, I think we saw quite a lot of buying actually of trust in Vietnam and China, which was possibly related to that rotation out of the US that James was talking about, and some relief actually that the tariff regime doesn't appear to be quite as rigid and strict as it first appeared. And we also saw something of a rally in the biotech sector, which I think has been really oversold before and lacking in interest and demand. So I think there was a bit of catching up in some of these sectors. So some very interesting thematics there. And the same applied actually to the trusts that were going down during August. Again, nothing outstanding here really in the numbers, although it's always interesting to look at the top one there, Seraphim Space, which I think is amongst the most volatile of all investment trusts. Over the last 2 years, the share price has ranged, I think, between 29 pence and 90 pence, so a massive range. And it's been selling off, actually, as there's been some money pulling out of growth capital over the summer. But I think maybe it's looking all right again. But the key theme here, you may already have spotted it if you've read a few names on the list, it's renewable energy, which really did, again, sell off quite a bit during the month. So I'll talk about that. So concentrating on the risers now, let's have a look at gold, which I think is really the outstanding movement over the month. We've seen the gold price being pretty strong all year, actually. This is a 1-year chart that I think demonstrates it's had this really quite strong momentum all the way through, and it had another leg up during the summer here. So gold has now breached new all-time highs. It's past the $3,500 per ounce mark. And it's really been, I think, a notable factor in pushing some of these commodity trusts higher. In some ways, it's been a perfect storm for gold. So many factors have coincided to push the gold price up. You've got these macro factors, so markets anticipating lower interest rates, and that means it's less expensive to hold gold, which is, of course, a non-yielding asset. You've had persistent inflation, which of course, again, gold is used as a hedge against inflation. You've had concerns about sovereign debt. Clearly, France is in the midst of a crisis here. The UK is struggling with its debt levels. And so that is, again, a recurring theme across many nations. And gold, of course, is completely independent of that. It doesn't require any help from governments. It's independent of government policy. And so, again, it's very useful as a hedge. I think we've seen buying from central banks, especially in emerging markets. And again, to some degree, what they're doing there is reacting to the political volatility in the US, and they're diversifying away from the US dollar, which has really been the reserve currency and a place where you park your money. But that's not seen as so reliable now. So some of that money is flowing into gold. And we've seen private investors putting money into ETFs. And then, of course, you've got the whole background that we've been struggling with for quite some time now of the war in Ukraine, the uncertainty in the Middle East, and, of course, Donald Trump. So I think there's a lot of factors here which have been supporting gold. And so it's not that much of a surprise, perhaps, that the price has been so strong. And the way for investment trust investors to play that has really been through Golden Prospect Precious Metals, which is around 86% exposed to gold through gold mining stocks. And I'll just make a couple of points about this trust, actually. The first thing, and this is really important, I think, is that this is a small trust. It's still, in spite of this strong rally it's had, it's still under £100 million worth of assets. And of course, there's been so much pressure during this consolidation phase for small trusts to disappear. And I think that's a mistake, where actually many small trusts offer unique access to specialist markets. And I really think this is a tremendous example of this, because not only is this clearly the best and really the only direct way to play gold through the investment trust market, but also you can see from the list of holdings here that Golden Prospect is buying small mining companies that you're highly unlikely to be identifying and buying yourself. So it's really offering you something very specialist, very niche that you can't do yourself. And that's why it's beneficial to have these smaller specialist investment trusts in our realm. So I don't want them all to disappear. I think that's a key point. So let's move on maybe to one that will disappear. And I'm just going to come back here briefly to Bellevue Healthcare, which I talked about last month. And then I was explaining that I didn't feel their massive buyback program was sustainable. Now, they're trying to defend their zero discount policy, but they've had to spend over £100 million of assets to buy back shares to support that. And when you started with 280 million in April, and the asset base has now shrunk to 160, you can very quickly see that wasn't going to carry on at that same rate. So it wasn't that much of a surprise when the trust announced a strategic review, and the board has said they're considering all options for the trust's future. Now, I think you've got to think about the quantum here, just how much of an asset base is left. So I think it's very possible that the board may hold a beauty parade of managers, because, of course, one of the issues here has been the underperformance of the current portfolio. So there could be a lineup of managers and they'll pick a new one. But I think realistically, if you're changing manager and changing the remit a bit, you do need to offer at least a partial exit to shareholders at NAV. And if you're doing that and some money is walking out of the door, then your 160 million maybe shrinks to 100. And at that point, it's probably not really economic to run this as a separate trust, not in the healthcare space. So my feeling is that some sort of merger or combination is more likely, but we'll have to see. Now, because Bellevue has been defending the zero discount policy and actually because it's been spending so much money on buybacks, it has been successful in doing that. The share price is actually on a very small discount to NAV. I think it's about 1.5%. So I don't think there's any arbitrage benefit to be had here. I don't think there's any reason to get involved if you're not currently a shareholder. So let's look at the downside now, and renewable energy infrastructure. The chart here shows you the average discount for the sector since the start of the year. And actually, again, I talked about this a few months ago when we saw some significant discount narrowing in the spring. And you can see that in April, May, and June, actually, the discount really did narrow quite a lot. It came in from about 34% to 24%, but it's now widened out again back to 30%. And I think maybe that's just the reaction, and it's a bit of profit taking. But also, I think there are two factors that have worked against renewable energy. One of those certainly is the interest rate background. And you've probably read in the press, actually, about long-term borrowing rates in the UK reaching their highest level now for 27 years. And that's been very unhelpful for the government. And that, I think, probably explains why Rachel Reeves has pushed back the budget until the end of November. She's giving herself some wiggle room there to hope things get better in the market. Although she is going to be delivering very bad news, actually, just before the Christmas period. So it might not do her rating any good. So higher borrowing rates are clearly a factor here, I think, because some of these renewable energy infrastructure trusts are considered bond proxies. So if you're getting higher rates of return on gilts, then that makes these less attractive. I think as well, over the summer, just generally the news flow felt a little bit negative from this sector. NAVs, where they were moving, were generally slipping off a little bit. There were some governance questions. So with Gore Street Energy, there was a challenge to the existing board there, which was fended off, but nevertheless, there have been some changes there. And also the lack of wind in the UK in the first 6 months of the year, which really hurt Greencoat, UK Wind, and also Trig to some degree. I think that just reminded investors that there are variables here that you can't control. So I think it's been relatively less attractive over the summer. But as we can see from this list, actually the discounts are really wide. I think you can probably ignore the bottom one there, the Downing one that's being taken out, and you can ignore the top one, the Hydrogen Capital Growth Trust, which again is about to be wound up, and I think that's going to have a big haircut to that NAV. So there's a big cluster of very large, wide, double-digit discounts. So there is a great deal of value in this sector. And for that reason, maybe it's not a complete surprise that we had that news that James was just covering there about Saba moving into the sector. And this really is something significantly different for Saba. And so we'll have to see actually whether this is a one-off or whether it's part of a sector-wide strategy. There are some signs it's going to move into these less liquid assets. I noticed it took a 1% stake in Life Science REIT as well, actually. And so there's a lot of scope here for improvement. SDCL Efficiency Income was trading on a 38% discount before this news, and it hasn't narrowed very much now. It's only come in by a few percentage points. So I think for investors, there's value here. And in effect, you can buy in if you want to, and you can afford to be patient because you probably don't have those tax issues that Saba has. So you can take those tremendously high dividend yields. With SDCL, it's 10% plus. You can take those yields and sit tight and see what develops. And my feeling is that if you're a patient investor, you probably will see some gains to come. But we'll have to wait and see. We'll see what happens with Saba, and we'll be watching those RNS announcements, I think, even more keenly than usual. I'm just going to have a quick look to see if there's any particular questions. I don't think there are, so I'll hand back to you, James.
Brilliant. Thank you very much, Andrew. Very interesting as always. And as I said in there, actually, I do completely agree with you about small trusts. Now, I am now going to bring in Prashant and hand over control to him. And he's going to tell us all about Ashoka India equity. Over to you, sir.
Thank you, James. Thank you, Andrew. So, to start with, maybe just a quick, um, let me just see how I will move this. Yeah. For those of you who might not be familiar, hopefully most of you are familiar. Um, the proposition, obviously, uh, India is a fast-growing economy, and it is very importantly, one should distinguish within all emerging markets are clubbed together the way we think about, and we have an emerging markets fund and a trust as well that James was highlighting earlier. uh, the demo India is one of the better functioning, in fact, as well functioning a democracy as any other in the world, developed or emerging. Worldwide, the data we've seen and analysis that we've done over the last 30 years, democratic markets have always traded at a substantial premium to authoritarian regimes. Think of the multiples that market has accorded to markets like Russia or China or others that usually always lower than democratic markets because of this relatively stronger property rights. In fact, I often joke that the best thing that the British left behind in India is not cricket, but the rule of common law, which then entails within itself the laws around property rights. Uh, and it is also one of the most inefficient markets from an alpha generation perspective. It presents a very fertile ground. And several studies have been done in the past. Some of the data we might see later in the call as well. To harness this alpha potential, we have, in my assessment or in my knowledge, the most well resourced team of seasoned investors by number or by caliber, yeah, which has demonstrated a very consistent and long track record through stock selection or bottom up stock picking. We consciously stay away from top down factor bets or market timing in any form. And what we bring to the trust market via the Ashoka India Equity Trust is a structure that is very well aligned, where the fees are that management team only earns any fees. The manager earns only fees only if the fund outperforms the benchmark. So we get paid only if we add value, and those fees are also paid over 3-year measurement periods and in the form of stock or units of the trust. That's somewhat unique structure, I believe, in the trust market, and something that our investors have greatly appreciated. Um, we won't go over each and every item, but this is the summary. We have, as I said, very well resourced team with performance first investment culture, a rigorous approach with a proprietary OPCO FinCo framework, which many of you might be very familiar with, a strong track record, and a best in class company structure. So, when it comes to investment culture, there are four key pillars. We call it performance first culture. It's a sports team like mindset that underlies the um, or is a foundation of the culture, where everyone on the team is driven by a single minded objective of generating highest returns for our client portfolios compared to the peer group. So the game here or the sport here or the score is capped on returns that you deliver for client portfolios. And nothing motivates us more than to score higher returns for our investors. And it is founded on these four pillars: team, philosophy, process, and portfolio construction. Just to touch very briefly on each, it's a 50-member strong team, of which 35 are involved in India research and decision making. Most recent addition, where my cursor is Hiren Dasani, many of you might know, he was the CIO or co-head of emerging markets at GSAM. Um, Someone whom I had hired at GSAM in 2006, nearly 20 years ago, had worked with him for 10 years, and then had recommended him to take over my role, which he did, which Goldman did. Point him is also the lead PM on India. And after 8 years in that role following my departure, he's finally decided to join us last month. And he's the 50th member of the team, further strengthening what is the best team, in my biased opinion, in the industry anywhere uh, in the world. Um, Going to the shared philosophy of the team, it's that outsized returns are earned over time by investing in great businesses at attractive valuations. So there's no robotic science here. It's something that every manager says: great business, attractive value. Um, but as I often give the example, just because something is simple doesn't mean it's easy. We all know that to have a healthy body, which is most important to us all, we must eat well, sleep well, exercise, and have a stress free life. Very simple, four things to do. Yet, the most difficult to do, despite being most important to all of us in our lives. Similarly, the consistent application of this approach is what I believe distinguishes ourselves from the peer group. What we consider now as great business is one that has these attributes: a superior returns on incremental capital, scalable, and well managed both on execution and governance. These are born out of the fundamental value equation here at the bottom of the slide, which is that value of any business is nothing but present value of future cash flows. To generate cash flows in the future, return on incremental capital have to be superior than cost of capital. The more superior they are, the better. Scalability is about the growth, which is the denominator, in the denominator of the equation. And when you have potential for cash flows and growth, you need management DNA for execution to deliver on those. And first and foremost, or above all, strong governance DNA, so that the fruits of the enterprise are shared with minority shareholders. Those cash flows are shared in proportion to our minority shareholding. Otherwise, it may be a great business only for the controlling shareholder, not for us all. In such cases, best to avoid those businesses. Our team has done a fantastic job over the years in avoiding governance landmines, and not just in India, across emerging markets, I would say. And that forms a important element of the returns that the portfolio then experience. We conduct in India, I would say, during the course of a year, close to 2,000 meetings collectively as a team with various company managements, their peer group, listed or unlisted, their suppliers, their distributors, where relevant, consultants, ex-employees, regulators, so on and so forth, in identifying such opportunities. And when we find them, it's important to value them logically and invest only if and as long as there is substantial upside to fair value. Uh, we are not of the school of thought that find a great business, buy it at any price, and hold on forever, and you'll make money. Maybe there is some merit to such an approach in generating average or somewhat above average returns in the portfolios. But our desire, very much, to go back to the performance first culture, our desire is not to just beat the benchmark, but to beat the best performing peer out there in delivering the returns to our investors. And to that end, valuation discipline is very critical. Having said that, we don't look at PE multiples or EBITDA multiples and so on, because in our view, in our framework, those are highly distorted and lead to misleading conclusions. What we focus on, again, first principles based approach of discounted cash flow, uh, which is adapted or enhanced to align with our philosophy that you saw. Again, not the forum to go through details of this, but in this framework, we divide any company, what we call OPCO FinCo framework, which is trademarked by us, divide the company into two entities. Let's say Glaxo, a UK company, if we were to evaluate. Glaxo FinCo, Glaxo OPCO. FinCo will house the plant and machinery and working capital. Revenue and EBITDA would be assigned to OPCO, from which it would be deemed to pay an operating lease cost for use of the factory or plants and working capital financing cost. And after paying taxes, what is left is in OPCO is excess return on invested capital related cash flows, because cost of capital has been paid out to FinCo. So two distinct deemed subsidiaries, which are distinct in the way to be valued. For invested capital here, by design, it only earns cost of capital. So it's very simple to value by first principles. It is one time invested capital. It's a low multiple business. So enterprise value is broken up into its two distinct components. What is the combination? What is the mix of these two provides a very useful insight. And once you rearrange the terms in this equation, you get the second equation, which is price to excess ROIC cash flow multiple. And that is the multiple which we use for companies when we compare relative valuation. For so well over 1,000 companies now in India, we would have this framework applied where we have what is the component mix of value for those companies and what is the price to excess ROIC multiple for those companies. That this provides a far superior, far more logical apples to apples comparison within a sector as well as across sectors compared to P multiples or EBITDA multiples, which are apple to oranges or even apple to lemons kind of comparisons in many cases. Yeah, so just moving on in the interest of time, the beauty about Indian market, and I have invested in developed world as well as across emerging markets, um, combined together several dozen countries. India is one of the few countries where there is a very large investment universe. There are 800 plus, I would say, for the purpose of the trust, there are well over 1,000 because we go deeper into the market cap spectrum. There are well over 1,000 companies, yeah, that to pick and choose from. And hence, that's one of the elements of being very alpha rich or fertile grounds for investing. Combine that with the large, well resourced team we have, well resourced in terms of number as well as caliber. So these are all tied together. It's not a coincidence or an accident that we have a large team. Recognizing that the nature of the opportunity is such very large in terms of scope and very high in terms of rewards if you get it right. Recognizing that our performance first culture, the idea is to generate highest return, we have deployed the resources to that end to mine, to harness this alpha and bring the best to the portfolio. In the interest of time, we'll keep skipping. In terms of portfolio construction, so, see, not only has the performance delivered by the team been very strong, peer group leading in terms of returns, be it total return or the outperformance, obviously they go hand in hand, but the consistency of that return has been unparalleled. Usually, it is presumed that high returns would mean high volatility, even in alpha terms. So, high outperformance must be associated with very high. So, long high term, a long magnitude of large magnitude of long-term outperformance must be because associated with high volatility of that outperformance in the interim time period. Whereas what our clients have hopefully experienced in our case is the largest of the magnitude and unparalleled consistency. And that is to do the consistency bit. So I've always said that the magnitude of alpha is a function of our stock selection capability, and the consistency of alpha is due to our balanced portfolio construction approach, where along with maximizing long term alpha potential, we also consciously seek to minimize uh, the short term volatility of that alpha, particularly by minimizing factor risks, because in our view, alpha is all in stock selection, whereas volatility comes from both stock selection as well as factor bets. Factor bets or top-down macro bets or thematic bets, they don't add any value in our view over time. There's zero-sum game, and hence we keep them to a very low level. We do tolerate some of these factor risks like small and mid caps. It's very well known everywhere in the world. Developed market like US or UK or emerging markets, small caps are more inefficient segment of the market. So India to begin with is more inefficient of a market. Within that, small caps would be even more inefficient. So we do allocate higher allocation to small cap because higher alpha per unit of capital we can generate. As you can see on the right hand side table here, portfolio average weight in small cap historically has been 33% compared to 9% of the index. And if you see the annualized excess alpha, it is about, these are all gross of fees and taxes, yeah, and they're more indicative, might not be precise. The actual numbers may not be precise to the decimal, as the software often does take day end prices and rather than actual transacted price and whatnot. But 2200 basis points of alpha annualized in small cap compared to 770 in mid and 200 plus in large. Even 200 plus in large is very difficult, would put us in the top ranks of a comparable peer group. Yeah, so nothing to scoff at because it's a more efficient segment of the market. But in smaller caps and mid caps, you'll see very high alpha potential. And this both, as it says here, small caps as well as pre-IPOs. We are very uniquely positioned in the Indian market where we are resourced to evaluate companies before they go for IPO. And we also are, in my assessment, we are the first port of call managers for companies coming to IPO if they wish to do pre-IPO, and then that spills over into anchor allocation or corner store allocations as well. And over the last 8 years, we've done over 50 of these in the trust vehicle. Trust vehicle is a perfect vehicle to do something like this, and that has hugely benefited from that. And our peer group are just not equipped to do this, and hence not been able to harness this alpha. We also, besides smaller caps, we also allocate more to the better governed segments of the market. Yeah, so certain sectors tend to be less represented in the portfolio, such as real estate, commodities, and even energy, utilities, and government-owned entities. Compared to that, other better governed segments of the market are higher allocation in the portfolio. In With the last couple of slides, I'm going to come to a pause here. So this is the performance over the last, before going to performance, yeah, I just want to reiterate that fixed management fee is zero, performance fees only paid in shares if we outperform the market over 3-year windows. And there is an annual redemption facility at approximately the NAV. Now, if you see over the last, since 2018 till now, 7+ years, the portfolio has returned since the portfolio got invested in at the end of July 2018, 15% GBP return. And this is net of fees. This is NAV, yeah, compared to 8.7% benchmark return for 629 basis points. Remember, this is not just net of fees. This and performance fee, this and expenses, this is net of taxes. In India, there are capital gains taxes. So what is 8.7 for the benchmark would likely be 7% for the ETF. It's not like the typical ETF, which is 30, 40, 50, 60 basis points below the benchmark. It'll be 150 to 200 basis points below the benchmark for an ETF because of the taxes. So the performance relative to ETF, which is the right way to look at it, because everyone's got to pay taxes, benchmark our artificial construct in that respect. So about 800 basis points of alpha, thereabouts, give or take. I haven't seen the actual numbers, give or take 10, 20 basis points would be the alpha, which is outlier of an alpha generation. And that's part of the reason why the portfolio has traded relatively close to, and the stock price has been relatively close to the NAV with, on average, a bit of a premium, which we'll see very shortly. So since inception, if you look at the NAV, 169% return compared to benchmark cumulative 80, compared to peer group, which has ranged between 33 to 62%. All of the peer group being on the other side of the benchmark, and the share price also correspondingly, you'll see, has far outperformed the peer group. This shows the discount or premium. On average, over the last 8 years, we've traded at a 0.5% premium compared to sizable discount. Elsewhere, it's partly to do with the performance, partly also to do with the way the fees are structured and the redemption window that we've offered. This has also allowed us then to tap the market. We've probably been one of the most prolific issuers of equity on the London Stock Exchange, particularly in the trust market, having grown nearly tenfold. When we launched in 2018, I remember the total proceeds were £46 million. Uh, at the time in the IPO, somewhat disappointed compared to the 100 million odd target that we had. And today it is, last I saw, was over 460 million pounds, so has grown tenfold. A lot of it is due to tap issuance, a lot of it is due to appreciation as well. And it has become the most liquid, second largest today, and the most liquid compared to the peer group. So I will pause here. There's a lot of other data on slicing and dicing performance, which predominantly shows that all of the performance has come for vast majority stock selection, which is aligned with the investment team's philosophy and portfolio construction approach. Thank you.
Brilliant. Thank you very much indeed. So trying to look at the sort of theme of the questions here. So some of them, sort of the big picture stuff. One of the things that has been talked about India for a while is that its stocks are relatively expensive. Is that something that you would reject, or do you feel that's true and it's just a question of looking for the attractively valued ones within that?
I'm glad you used the word expensive and not overvalue. Yeah, because a big difference between the two. Expensive, look, let's look at a British car. Range Rover is more expensive than a Fiat. But I'm sure that people would appreciate why there is a difference, a far better engineered vehicle that Range Rover is. Um, in case of stocks, if we were to talk about, now most people associate a higher multiple with merely um, growth. Yeah. Now, growth is not the number one reason for in determining multiple. I'm just going to go to a particular slide here. Yeah. So growth is not the number one reason in our view. And you can look at any sector in UK. You will find that a company that is better governed, more often than not, would be trading at a substantial premium, where corporate governance is superior, would be trading at a substantial premium compared to other companies within the same sector where corporate governance may be somewhat weaker, even if this weaker governance company has far higher growth. Yeah, because what corporate governance stands for, first and foremost, is that you as a minority shareholder would have fair rights, proportionate rights to cash flows of those company in future. Weaker governance means that is a question mark, right? Now think about it for country as well. I'm not saying every company in India has superior governance than anywhere else. I know some of the stories out there might suggest otherwise. Those stories are there everywhere, including in the US. But at a aggregate country level, what I was talking about earlier, India has and this is a slide that hasn't changed. I put this slide together probably 19 years ago. At the bottom, what I've highlighted here it's a very fundamental pillar of the Indian market. India is even though it's an emerging economy, or emerging market, when it comes to the government or the nature of the construct of the government, it's a fairly mature democracy within which what it means is it has independent central bank, as independent as probably anywhere in the world, election commission, judiciary, probably judiciary, given what's happening in some of the developed world countries like US, it seems like it can be not just, I used to always say relative to emerging markets, but now tempted to say anywhere in the developed world as well. Yeah, which then bestows strong rule of law and strong property rights under, as I was saying, the common law system that we inherited. So in India, it's not easy for the government to confiscate your property. You can sue the government, and people sue the government all the time in India and win against the government. Even a small farmer sues the government and wins against the government, which often was criticized in case of India that it slows progress. India can't build a highway for 10 years, whereas China built the Three Gorges Dam in 5 years. Yeah, even though it entailed displacing millions of people. I would always argue, I mean, isn't that a worry? Isn't that a plus point in case of India, that even if a country that respects its own small farmers' rights might potentially respect a foreign investor's right, whereas a country which cannot protect or does not respect their own farmers' right, what confidence you have in their system protecting a foreign investor's right? Yeah, a lot of these things have played out over the last few years, to to hurt the returns that investors have earned. And this is what has, I'm surprised we haven't seen more work along these lines. We have actually written a newsletter in 2021. The title of that newsletter is The Indian Premium, which goes over all these things in greater detail, and a lot of it is pioneering work from our team members. You see this top left hand side graph, it shows the dark blue line, that is the median P multiple that more democratic countries have traded over the last 27 years. And the light blue line is the same for the less democratic or authoritarian countries. There's always been a huge difference at the turn of the century. In fact, it was 100% premium that democratic countries traded at. Today, it's, if anything, narrower. So emerging markets by weight, if you see, a lot of it, half or maybe more or somewhere around there, is authoritarian countries. So when you just compare against EM average, it's not a apples to apples comparison. And if you compare against the US, which I think is in many respects more of a comparable, be it the growth or the governance and the democratic nature, the bottom right hand side, if you look at, India has always traded at a 1%, just minuscule, in line with US market. Today it is at 11% discount. Yeah, so I would argue, I'm not saying it's table pounding or something, but historically, it's only traded at wider discounts in times of crisis like global financial crisis or COVID pandemic. Relative to its own self, it's trading in line with, again, the last 10, 11-year-old since in the Modi era at about 20 times.
One of the factors, I suppose, that's been affecting sentiment has been tariffs everywhere. And there's obviously a big tariff row going on at the moment between India and the US. Is that affecting the portfolio or the way you think about companies?
So first of all, let's look at some facts. I agree that that's a talking point, and maybe weighing on recent sentiment, and hence maybe 1 or 2% hit to the market. The market's quite smart. If you look at the Indian market, the construct of only 1.4% of India's benchmark is subject to tariff risk. Yeah, and that too, at varying. It's not that it's going to 1.4% is going to go to zero. It may suffer. Half of it may suffer. Yeah, but it's less than 1% hit potentially. India is not an export dependent economy, number one. A lot of this export revenues that we earn is in software, IT service. They're not merchandise goods. We are usually importing mostly when it comes to goods. So that is just first level of one perspective. Obviously, we don't know how it would settle and all, but that's one perspective. But more importantly, there are always going to be concerns when it comes to any market even UK, US, or any market. Yeah, and I was just in my comments I mentioned that in 2018 we only raised 46 million instead of the targeted 100 million, was because just when we were on the IPO time, those 2 or 3 day window, oil price spiked to $88 or $90, and everyone just has this misconception, well, oil price is going up is bad for India. Yeah, maybe that was the case in 80s, 90s, or whatever, when oil as a percentage of GDP was far higher. Today it's immaterial, I won't say immaterial, but it is not that big of a deal. If I show you, this is since 2007. You can go back since the turn of the century, which is 2000, year 2000. And if you were told at that time that all the things are going to happen that actually happened, yeah, starting, we were just coming out of a war with Pakistan. There were terrorist attacks on our parliament in 2001. People forgot about that. Train attacks in 2006. Hotel, which is probably people remember, in 2008. Global financial crisis. Oil prices going to 150. Massive corruption scandals that came to light during 2010 to 2014. COVID pandemic, Russia's invasion of Ukraine. We've kind of jumped through numerous others because there wasn't space, and but all of these are listed here, just too many. The fragile fire, the taper tantrum, Trump getting elected was a big risk, Brexit was considered to shake up the world, fears of Brexit, pigs, um, Russia, Ukraine, and all the way. You would not have touched India with a barge pole if you were worried about, if you were told about all these things, you would have not touched India with a barge pole. But look at the returns during this time. Since the turn of the century, India has generated 11.2% annualized dollar return, compared to global world return of 7.3, US, which is the flag bearer in capital markets, 8.5% return, and emerging markets 7.9. These are all dollar returns. Now, this is history. I'm not saying it's going to repeat going forward as well, similarly, but all I'm saying is all these macro risk factors you have to keep in perspective. Look, here at the bottom right hand side, India has delivered the highest earnings growth in dollar terms as well at 7.1, which is what has fueled in great part the higher returns, because earnings is the important element of returns. So the important thing to not underestimate is 1.4 billion people every morning wake up and proceed with their day with the aspiration, with the aim to improve their way of life. Each individual counts for very little, but when you collectively look, the collective of 1.4 billion is such a powerful force, that these macroeconomic risk factors of the kind of tariffs, they are not even, I would say, pebbles in front of that bulldozer or that juggernaut. Yeah. And believe me, in a few years time, when we have this slide again that I was showing earlier, where there were numerous events that happened, probably this Trump tariff threat would not even make its way on this slide.
Great, thank you very much. Everybody likes to put some labels on things. Are you a value investor, a growth investor, a quality investor? Or are you a sort of mix of all of these things?
Certainly. See, we try hard. I've always tried hard to not get boxed. Uh, and it's not just boxed externally, but also don't want the team to start thinking that we are A kind of investor, B kind of investor. Obviously, growth is just one element of the value equation. The slide that I showed there, G, which was in the denominator, right? It is one element of that equation. It is a very important element of the equation, as you can see here at the bottom of the slide. Yeah, but there are several other elements of the equation as well. But yes, what I would say is our focus on governance, yeah, that does land a certain quality bias. typically, first of all, the words value and growth have been butchered by index makers. What is high price to book is growth, what is low price to book is value. They've just hijacked the meaning, true essence of the word value. Because value, the other way to think of value is, undervalued or overvalued. Yeah. Low price to book doesn't necessarily mean undervalued. A company can be low price to book, but be exorbitantly overvalued. Yeah. So, you have to think of it as growth and so let me not again but to me in value category you have combination of both, some genuinely undervalued companies but also a lot of junk. Obviously a junk car is not going to be worth a new car. Yeah? So a lot of junk is also there in value. So we are selective within value. We do invest in value segments. A lot of we believe all of our companies are value for the growth and the quality they are, each one of them. Why would we buy something which is not value? If it is fairly valued, we are out before it is fairly valued, is how I would like to think of it. Yeah? But we don't get into value traps. The problem with the value segment, it has value traps as well as genuine value, and the counter is true for growth as well. Growth for the sake of growth is no good. So selective in both growth and value, but we do tend to have a quality bias, particularly because of the governance focus.
Brilliant. Thank you very much. The fee structure always attracts interest. Can you is this common to everything you run, or is this just one thing for the investment trusts?
In the trust world, it is true, and the reason is when we came to the trust world to raise money, investors were like, we're tired of trusts, particularly emerging market, particularly India, because there are 3 existing trusts. They're all trading at 15 to 20% discount. You may be great and whatnot, but what if you go to a discount like others? Why won't you go to a discount? So we said, okay, this is a good way to address it, and that's where we said we'll take 0 fixed fee and only get paid if we are adding value. Once we started that, it was so well liked that when we launched EM, there was really no other way that we could have launched it. We can't have the whole business like this. Yeah, it would be too volatile for the business. But for part of the business, this is very much doable.
And when you do get shares from performance fees, how long do you hold them for? Is they kind of locked in?
Yes, see, what we've stated is I think 3 years, but in the past it is, and again, I'm not making any commitments, but in the past, I believe it's been longer than 3 years.
Brilliant, thank you. I'm conscious of time, actually. We probably should stop there, I think. I could keep going forever. But no, it's good, it's good. Thank you very much indeed, Prashant. Shall we sort of skip forward to the disclaimers? Otherwise, we'll be in trouble.
Yes.
Just go through that way.
Should I bring it up quicker?
No, it's all right. We'll get there. No, I'm doing it right time. There we go.
Almost there.
Yeah, let's just say 1, 2, 3. Good. Very good. Thank you very much for taking your time today. Obviously, I'm a shareholder. I don't know if you're Andrew, are you?
Thank you. Thank you, James.
Are you an investor in Ashoka? Yeah, he's nodding. Yeah, so we're both very keen to see this thing keep on going. So we'll follow it with interest and we'll cut you back again another time. But thank you for your time today.
Thank you so much.
Cool. Next week, I'm talking to one of the managers of JP Morgan Asia Growth and Income. So please do come back again and see us for that. And then the other thing, again, very relevant for Prashant because he's a nominee, is please do vote in our Investors' Choice Awards. It's all about what you think about these trusts, not what we think. So we'd like you to go on there and vote, please. And if you do vote and you manage to predict all the winners, you're in the chance of winning £5,000, which is something we did last year. So thank you very much indeed for your time this morning, and we'll see you again next week.
Thank you.